Hi, everyone. Welcome in for another episode of 3 Minute Success. I'm your host, Jarrod Music. I'm here today talking about hitting tax singles as opposed to trying to hit tax home runs. So, the job as an entrepreneur is to make sure that you're doing integrated tax planning, meaning we're looking at your business and the income that it is going to generate in concert with your personal wealth and everything that's happening over there, and making sure that you are taking care of the day-to-day items and the year-to-year tax planning that consistently delivers value. So, rule number one, integrate the two of them together. Do not look at your personal and your business tax planning separately. Particularly if you have pass-through entities, your business income and what it creates for you is personal income. It's all going on your personal return anyhow. So be looking at those together. Try and forecast and understand, when are we going to have outlier years, high and low in income, and what does that mean personally? Then you want to look at, okay, what are the actions I can take? So, expense clustering in the business. If you have equipment purchases or new hires to make, do you want to do that at certain times to be able to influence the amount of taxable income that you have? Same thing on the personal side, looking at allocating to different investments or recognizing capital gains. There are going to be different years that create different outcomes for you. So a classic example is if you have a retirement program inside your company and you participate in that. If it has a traditional option and a Roth option, you're going to want to use the traditional option more likely in high income years when you're in a higher marginal tax bracket personally, and perhaps use the Roth option, which is the post-tax retirement vehicle. So you're choosing to pay tax in the year in which you make contributions, and then you have that money tax-free in the future. So you're looking at, what are my marginal tax brackets today? What do I think they're going to be in the future? And make decisions accordingly. You can also look at capital gain recognition and capital gain timing, or recognition of losses in that same bucket. When do I want to do those? When do I want to put them together? We also see things like charitable giving and gifting. Do you want to use a donor advised fund strategy where you're going to make a completed gift in this year, but perhaps make the ultimate gift to the charity this year? That's a great tool that we can utilize. You can also just utilize clustering. So if you might make a 3-year commitment to do $5,000 a year to a specific charity, but you're in a really high income year, can you cluster that in and just do a $15,000 gift this year? These are all things which are not going to drastically alter the outcome by themselves. However, used in concert and used consistently over time, you're hitting singles with your tax planning. The key to doing all of this is making sure that your wealth team, your CPA, and your state attorney are all working in concert. Even if you have a $50 million net worth and you're looking at things like, how do I make sure I'm taking maximum advantage of state tax exemption amounts before they reset in 2026, it may create millions of dollars of long-term estate tax value, but relative to the total size of your net worth and how it's going to feel today, it'll still feel like hitting a single because it's not drastically altering your present day outcome. This is the important planning work that should be done on an ongoing basis and really creates value for you, your business, and your family over the long term. So think about hitting singles, doing the basics. Work with a team that can help you do that and stay on track, because it's not the sexiest thing in the world, but it creates value. If we can help you, head over to entrepreneuraligned.com. Would love to have the conversation. Thanks so much.